Hi friends, in this small video we are going to discuss a very important function of an Islamic bank, that is deposit mobilization and profit distribution to the customer. We all know that an Islamic bank operates on Sharia principles of profit and loss sharing and mobilizes deposit on profit and loss sharing basis and then eventually invest it into financing assets and investments to earn returns and distribute it back to its depositors. If we go through a balance sheet of an Islamic bank, we would find current account deposits, we'd find saving deposits, and time deposits. By definition, current accounts are mobilized on WAD on the basis of WAD contract, and it is basically a safekeeping account in which no returns are being offered to the customer. Whereas the saving and the time deposits are entitled and to profits and are also called remunerative account. They operate on the basis of Mudaraba contract, that is a profit sharing contract, and the returns being realized out of these funds is being shared on the basis of a mutually contractually agreed profit sharing ratio. Another interesting thing to note about these investment account holders deposit or the Mudaraba deposit is that they are neither reported as liability nor as shareholders' equity. They are reported separately, somewhere in between the liability and the shareholders' equity, as investment account holders' equity. And this requirement is stipulated by the accounting standard setting body of Islamic financial institutions, that is AOFI. If you go through the website and other relevant disclosures of an Islamic bank, you'd find investment account holders' deposits being classified as on the basis of tenor and deposit volumes, as well as you will find applicable weights defined for every deposit subclassification. And as a simple investor, they might make you wonder what are these implying tables, and how I would get to know the applicable rates on my account. So, with this preamble in mind, I would like to focus my presentation on three bullets. How are these investment pools operated by Islamic banks? How is the income determined which is to be distributed amongst the investment account holders? And lastly, how are these profit distributed amongst the various stakeholders of an Islamic bank? To keep things simple and meaningful, I've tried to come up with a practical example with a schematic or illustrative sort of representation of what actually happens and how is this profit generated from the asset side being distributed between the bank and the investment account holder. So, for example, we have an Islamic bank operating an investment pool of $100 million being contributed by the shareholder equity, the current account depositors, and the investment account holders. The shareholder are contributing 10 million. The current account $50 million is coming from the current account deposits, and the investment account holders are contributing 40 million to make it up to sum it up to $100 million. The proceeds of the funds from this investment pool are deployed in financing as well as investment assets. Now, for the sake of this example, we assume that the bank's management, that is the Mudarib, manages to realize a periodic income of $1 million over a joint investment pool of $100 million. The distribution of this $1 million is the important part, which has evolved over the years into a sophisticated profit distribution framework. The joint investment pool, $1 million, $600,000 are attributable to the bank, being a joint investment pool with $60 million being contributed by jointly contributed by the shareholders' equity as well as the current account depositor, which represents, of course, the bank's part in the joint investment pool. The remaining $400,000 is supposedly the investment account holder's profit, which is further distributable amongst the Mudarib, that is the bank, and the investment account holder on the basis of mutually contractually agreed profit sharing ratio, which in our case is assumed to be 70 is to 30. That is 70 is the part attributable to the Mudarib, that is the bank, and 30 is for the investment account holder. But as a matter of standard practice, this profit of USD 400,000 is subject to deduction of profit equalization reserve that is assumed to be 5% in our example, setting aside $10 million in this particular reserve. Profit equalization reserve is by definition is a provision for profit smoothing in case of lower investment returns to offer a competitive returns to avoid displaced commercial risk. Thus, eventually, on the basis of profit equalization reserve, profit sharing income ratio attributable to the bank's investment account holder, the Mudarib gets works out to $100. Whereas $114,000, that is 30% of $380,000, is allocated to investment account holders. This amount of $114,000 attributable to the investment account holders is subject to the deduction of another reserve that is maintained by Islamic banks as a part of this safety net design and is called investment risk reserve. This reserve, as referred earlier, is adjusted from the investment account holder's income after the deduction of Mudarib's share. Here we assume deduction of $2,000 or 1.75% to leave us with an amount of $112,000 for the investment account holders. Here it would be important to note the thin difference between the timing and the purpose of the two reserves maintained by Islamic banks. Profit equalization reserve is deductible from income before the Mudarib's share is allocated. Besides, profit equalization reserve is for profit smoothing purposes, whereas IRR is for investment losses. Now that we have arrived to a final number of $112,000 attributable to investment account holders, in the next part, I would be discussing the distribution of the profit amongst the various investment deposit products defined on the basis of tenor and volumes of the deposits and the respective product weights assigned by the bank's management. Moving on to the last and somewhat techy part of this presentation, that is, how is this $112,000 profit, as discussed in the previous slide, is allocated amongst the investment account holders. Here you go with the sample weights classification of an Islamic bank as quoted on their website. As you can see, the distribution of weights starting from 0.3 up to 2 across time-based classification from 1 month to 12 months. You can also see here that the weights for 12 months deposit is twice the weight of 6 months deposit. The distribution of actual deposit balances across all deposit classes is also presented, with $20 million in 1 month class and $1 million in 12-month class. The total profit of $112,000 is distributed in accordance with the weighted balance calculated by multiplying actual balances with its respective weights. For example, profit rates for 1 month deposit class shall be calculated by dividing the weighted balance of 6 million by the aggregate weighted balance of 21.2 million and multiplying by $112,000. This gives in the profit amount of US dollar 31,700 approximately, which is when divided by the actual balance of $20 million provides us with the actual rate of 0.16%. Now this serves as the rack rate for the overall 1 month product class of investment account holders. As we can see here that these weights are set on bank's discretion to incentivize higher tenor deposits, as obvious in case of 12 months deposit offering 1.06% as against 0.16% for 1 month deposit. So friends, this is it on the profit distribution
I hope you
mechanism. So by now, I'm sure you would be able to find out your applicable rack rate out of these tables disclosed on Islamic Bank's website. For example, if you invested US dollar 10,000 for 6 months, you will be getting a return of $53. So friends, this is it. I hope you find it
you have
useful.
developed
A fairly good
always
idea
welcome
about
feedbacks.
how
Take
these
care and
investment pools are
goodbye.
being managed, how the income is determined, and how are they actually distributed. Looking forward to have your feedbacks and suggestions. Thank you and goodbye.
I'm looking